Let me begin with a question that has been exploding across comments, emails, and private messages since the start of this week. It's the same question over and over again, coming from investors, traders, and people who simply follow global markets. Why is silver falling while the world is moving closer to war? Why is a metal that is supposed to protect wealth during chaos suddenly collapsing while missiles, airstrikes, and geopolitical tension dominate global headlines? At first glance, the situation makes absolutely no sense. In fact, if you only follow the basic narrative most financial media pushes, the price action looks completely irrational. But the truth is that markets are rarely simple, and the deeper explanation behind this move reveals something extremely important about how modern financial systems actually respond to crisis. Right now, we are witnessing a moment where the relationship between geopolitical events and market reactions is exposing the difference between theory and reality. Many investors assume that whenever war begins, precious metals automatically surge. Gold rises, silver follows, risk assets fall. That is the textbook explanation. Yet what is happening in real time shows that markets do not operate on simplistic assumptions. They operate on probability, expectations, and second-order consequences that often matter more than the event itself. And that is exactly what is happening today. To understand this properly, you have to step back and look at the chain reaction unfolding beneath the headlines. The immediate events themselves are already historic. Over the weekend, the United States and Israel launched coordinated military strikes against Iran. These were not symbolic strikes or limited tactical operations targeting a single military facility. According to multiple reports, the strikes resulted in the death of Iran's supreme leader, Ayatollah Ali Khamenei. When a nation's top leadership is eliminated in a military strike, that changes the geopolitical landscape instantly. Iran is not just another country involved in a regional dispute. Iran sits at the center of one of the most strategically important energy corridors in the entire world. The response from Iran came quickly and aggressively. Iranian forces launched strikes against American military installations across the Gulf region. Bases located in the United Arab Emirates, Qatar, Kuwait, and Saudi Arabia were all targeted. Reports also confirmed attacks on diplomatic sites and civilian infrastructure. At the same time, Iranian leadership announced that their forces now claim complete control over the Strait of Hormuz. This is where the situation becomes extremely serious from an economic perspective. The Strait of Hormuz is not simply a narrow body of water on the map. It is one of the most important energy choke points on the entire planet. Roughly 20% of the world's oil supply passes through that single corridor. That represents around 20 million barrels of oil moving through those waters every single day. Energy shipments from the Persian Gulf toward Asia, Europe, and other global markets all depend on safe passage through this route. When control of that passage becomes uncertain, the consequences ripple through the entire global economy. Oil does not just power cars or airplanes. Energy costs influence nearly every sector of modern life. Transportation, manufacturing, shipping, agriculture, technology production, and even food distribution are all tied to energy inputs. When energy flows become threatened, markets react immediately, and we are already seeing that reaction. Oil prices have surged exactly the way you would expect when a supply disruption of this magnitude becomes possible. Markets are rapidly pricing in the risk that energy shipments could be interrupted or delayed. Airlines across the Middle East have already been forced to change operations dramatically. According to Flight Radar 24 data, more than 12,300 flights worldwide have been grounded since the strikes began. Airspace closures across the region have disrupted global travel routes, logistics chains, and cargo transportation. At this point, the conflict in the Persian Gulf has entered its fifth day. There is no clear sign of de-escalation, and the possibility of further military escalation remains very real. Normally, in a situation like this, investors would expect precious metals to surge as safe haven demand increases. Gold and silver historically serve as financial protection when uncertainty rises, but instead of rising, silver has dropped roughly 11%. So again, we return to the central question: how does that make any sense? The answer becomes clearer when you realize that markets are not reacting to the conflict itself. They are reacting to the inflation consequences that the conflict could create. Investors are already looking beyond the immediate military events and asking what the economic aftermath will look like. And the answer to that question revolves around inflation. Consider what happens if the Strait of Hormuz becomes partially blocked or significantly disrupted. Oil prices would surge dramatically. Every country that depends on Gulf oil imports would face higher energy costs. Transportation becomes more expensive. Manufacturing costs rise, shipping costs increase, electricity prices climb. Suddenly, the cost of producing nearly every product in the global economy increases. Energy inflation spreads rapidly because energy sits at the foundation of economic activity. When oil rises sharply, inflation does not remain limited to gasoline prices or airline tickets. It spreads through supply chains, raising the cost of goods and services everywhere. This is exactly the type of inflation that central banks fear the most because it is extremely difficult to control, and we are already seeing early signals of that pressure building. European natural gas prices have surged more than 70% in just the past 2 trading sessions. That is not a small fluctuation. That kind of move signals that markets are beginning to price in the possibility of a sustained energy shock. When inflation begins to surge, central banks face a difficult choice. Over the past year, many major central banks have been gradually cutting interest rates because inflation appeared to be cooling. The Federal Reserve, the European Central Bank, and the Bank of England all moved toward looser monetary policy as price pressures seemed to stabilize. But if energy costs suddenly surge again, that entire assumption changes. Central banks cannot ignore rising inflation indefinitely. If inflation accelerates beyond their targets, they are forced to tighten policy again. That means raising interest rates to slow economic activity and reduce price pressure. Higher interest rates strengthen currencies, particularly the US dollar, because global investors seek higher yields. In fact, we already saw a signal of this shift from the Reserve Bank of Australia. Despite expectations that many central banks would continue easing policy, the RBA delivered a rate hike after inflation refused to moderate. Australia's economy is highly exposed to global commodity flows, which often means it detects inflation pressure earlier than other developed economies. When the RBA begins tightening while other central banks are still easing, it suggests something important is changing in the global inflation picture. Now combine that signal with an escalating conflict in the Persian Gulf and the risk of an energy shock. Markets are beginning to reconsider the entire interest rate outlook. Just a year ago, many investors believed aggressive rate cuts would continue through the middle of the decade. Today, some traders are starting to price in the possibility that rate hikes could return before the end of the year if energy inflation persists. And this is where the connection to silver becomes critical. When expectations for higher interest rates rise, the US dollar typically strengthens. Higher rates increase yields on dollar-denominated assets such as treasury bonds. Global capital flows toward those higher returns, pushing the dollar upward. As the dollar strengthens, commodities priced in dollars often face downward pressure. Silver, like gold and most other commodities, is priced globally in US dollars. When the dollar rises sharply, it takes fewer dollars to buy the same ounce of metal. That mathematical relationship creates downward pressure on precious metal prices, even if the underlying fundamentals remain unchanged. This dynamic explains why silver has dropped despite geopolitical turmoil. The market is not ignoring the conflict. It is reacting to the inflation consequences and the resulting shift in interest rate expectations. Instead of flowing into metals, safe haven demand has moved into the US dollar. For several years, the dollar had been losing some of its safe haven appeal as investors increasingly turned toward precious metals, but this particular crisis has temporarily reversed that trend. The market now sees the dollar as the primary refuge because higher interest rates could follow if inflation surges. I know this feels counterintuitive. The instinctive assumption is that war should automatically push gold and silver higher, but financial markets rarely operate on instinct alone. They respond to a complex web of expectations, economic projections, and policy reactions. Right now, that web of expectations is favoring dollar strength over metal prices. But the story does not end there. Because beneath the surface, another development is quietly unfolding that could eventually change the entire equation. And that development is happening in Dubai. Now let's move deeper into a part of the story that most analysts and commentators are barely mentioning, yet it could become one of the most important pieces of this entire situation. While traders and financial centers are focusing on charts, interest rates, and the dollar, something extremely practical has been disrupted in the real world. The global logistics network that physically moves gold and silver around the planet has been partially shut down. And the center of that disruption is Dubai. Flights carrying precious metals in and out of Dubai have been grounded indefinitely. This is not a small logistical inconvenience or a minor transportation delay. The United Arab Emirates plays a central role in the global precious metals supply chain. Dubai acts as a major refining hub, a transit point for shipments, and a gateway connecting Western vaults with Asian buyers. Gold and silver that move from Switzerland and London toward markets like India, China, and the broader Asian region frequently pass through Dubai during the journey. When that hub suddenly stops operating normally, the physical pipeline for metal shipments begins to seize up. Iranian missile strikes in the region triggered the partial closure of UAE airspace, forcing airports in Dubai to suspend operations. Without functioning air routes, the transportation system that moves precious metals between trading centers becomes severely constrained. To understand why this matters, you have to know how gold and silver are normally transported between global markets. Despite their enormous value, These metals are not moved by armored convoys across continents or fleets of cargo ships traveling for weeks at sea. Instead, they are usually transported inside the cargo holds of commercial passenger aircraft. This method is efficient, relatively inexpensive, and widely used throughout the industry. Moving gold between major financial hubs using commercial aviation can cost less than $1 per ounce. Because airlines operate thousands of flights daily, logistics companies can move large quantities of precious metals quickly and securely while spreading the transportation cost across existing airline operations. The system works smoothly when aviation networks function normally, but when thousands of flights are suddenly grounded, that system breaks almost instantly. As we mentioned earlier, more than 12,300 flights have already been grounded worldwide since the strikes began. That disruption affects far more than tourism or passenger travel. It also affects global cargo flows, including high-value shipments like bullion. Traders and logistics companies have already reported indefinite pauses in precious metal shipments moving through Dubai. They are attempting to reroute consignments through alternative locations, but the options are limited and complicated. Transporting high-value cargo like gold and silver across land routes introduces enormous security concerns. Moving physical metal through multiple borders during a regional conflict raises insurance costs dramatically and exposes shipments to potential theft or interception. Industry veterans who specialize in precious metals logistics have pointed out that overland transportation creates layers of complexity that most traders are not equipped to handle. Security arrangements, insurance coverage, customs clearance, and political risk all become far more complicated when shipments must travel through unstable regions by land rather than by air. Here is where the situation becomes especially interesting. While the paper price of silver has been falling rapidly in financial markets, physical premiums in certain regions are already beginning to rise. In Saudi Arabia, for example, premiums on bullion products increased shortly after the airspace disruptions began. Analysts monitoring the physical market confirmed that buyers were paying more above the official spot price in order to secure available supply. This divergence between paper markets and physical markets is extremely important. Futures markets, where silver contracts are traded electronically, can react quickly to macroeconomic factors, such as currency strength or interest rate expectations. Algorithms, hedge funds, and institutional traders can move prices rapidly through futures contracts without any physical metal changing hands. The physical market works differently. Physical premiums represent the additional price buyers must pay above the paper market price to actually obtain real metal. When physical demand remains strong while supply becomes difficult to deliver, those premiums increase. In other words, the paper market might suggest that silver is becoming cheaper, but the physical market might tell a completely different story about availability. Right now, we are seeing exactly that type of divergence beginning to appear. Paper prices are falling due to the stronger dollar and rising interest rate expectations. At the same time, the physical supply chain that normally delivers metal to key markets has been disrupted. Buyers who want actual bullion may soon find that availability becomes more limited. This situation creates a tension between two different pricing mechanisms. On one side, you have financial markets reacting to macroeconomic expectations. On the other side, you have physical supply and demand responding to real-world logistics disruptions. When these two forces begin moving in opposite directions, the resulting gap can become extremely significant. Eventually, those two prices must converge. Either physical premiums fall back toward the paper price as supply chains normalize, or the paper price rises to reflect the tighter physical market. Historically, when supply disruptions occur in the precious metals market, paper prices eventually move upward to align with physical demand once logistics constraints become fully visible. Another factor worth considering is the geographic shift in demand patterns that occurs during periods of uncertainty. Western investors often dominate futures markets and financial speculation, but physical demand frequently comes from Asian buyers who view gold and silver as long-term stores of value rather than short-term trading instruments. When those buyers continue accumulating metal despite short-term price volatility, it places underlying pressure on available supply. Premiums in India have remained elevated for weeks. Buyers in China continue paying noticeably higher prices through the Shanghai Gold Exchange compared with Western spot markets. These differences indicate that the global physical market may be experiencing stronger demand than paper prices currently reflect. When buyers who actually intend to hold metal for long periods are willing to pay higher prices than those shown in futures markets, it signals that something beneath the surface may not be fully reflected in financial pricing yet. These physical signals do not always move markets immediately, but over time they often prove to be extremely important. At the same time, we cannot ignore the fact that market psychology also plays a role in price behavior. When investors see silver falling sharply during a geopolitical crisis, many assume that the bullish narrative for precious metals has been invalidated. Some traders panic and sell their positions. Others hesitate to buy because they expect further declines. That reaction itself can amplify the short-term price drop, even if the longer-term fundamentals remain intact. Markets often overshoot during periods of uncertainty because participants react emotionally to price momentum rather than carefully evaluating the full set of underlying conditions. But beneath the volatility, there are still structural forces influencing the silver market that existed long before the current conflict began. Industrial demand for silver continues to expand through sectors such as solar energy, electronics manufacturing, electric vehicles, artificial intelligence infrastructure, and defense technology. Many of these industries rely heavily on silver's unique conductive and reflective properties. At the same time, mining supply has struggled to grow at the same pace as industrial demand. Bringing new silver mines into production requires significant capital investment and long development timelines. Environmental regulations, permitting delays, and geological challenges all limit the speed at which supply can expand. This structural imbalance between supply growth and industrial demand has been developing quietly over the past several years. Even before geopolitical tensions intensified, analysts were already discussing the possibility of tighter silver inventories as demand from renewable energy and advanced technology sectors continued increasing. When you combine those existing structural pressures with a sudden logistical disruption in one of the world's most important precious metals transit hubs, the long-term implications become difficult to ignore. The paper market may be reacting to short-term macroeconomic factors, but the physical market is beginning to signal a different story. And this is precisely why the current situation requires a deeper level of analysis than simply watching price charts. Multiple forces are interacting simultaneously. Currency strength, interest rate expectations, geopolitical risk, energy inflation, supply chain disruptions, and industrial demand are all influencing the market at the same time. Understanding which of these forces will dominate over the coming weeks and months is the key challenge facing investors right now. Some of these factors support lower prices in the short term. Others suggest potential upward pressure once supply constraints and inflation dynamics become clearer. The next step is examining what the technical picture reveals about where silver could move from here. Because while fundamental analysis explains why the market behaves the way it does, technical analysis often reveals where the most important price levels exist, and those levels may determine whether the recent decline becomes a deeper breakdown or simply a temporary correction before the next major move. Now, we need to look at the technical landscape because fundamentals tell us why something is happening, but technical structure often tells us how far a move can go before it changes direction. Markets constantly fluctuate, but certain price zones become critical battlegrounds where buyers and sellers decide the next phase of the trend. Silver is currently trading inside one of those decisive zones. During the height of the panic selling earlier this week, silver briefly dropped toward the $78 region. That area acted as immediate support and managed to hold despite the heavy pressure from sellers. The fact that buyers stepped in near that level suggests there is still demand for silver even during the recent turmoil. However, the most critical technical floor sits significantly lower around $64. This level represents the base of the broader trading range that has defined silver's price behavior for several months. If that level were to break decisively on a daily closing basis, the entire technical outlook would change. Instead of a temporary correction within a larger uptrend, the market would begin forming a new downtrend structure. That is why many traders are watching the 64 level very closely. It is essentially the final defensive line for the bullish narrative. As long as silver remains above that threshold, the possibility of recovery and continuation of the broader trend remains alive. On the upside, the market is currently struggling to maintain momentum above the 20-day simple moving average, which sits near $83. That moving average often acts as a short-term indicator of market sentiment. When price trades above it consistently, buyers typically maintain control. When price struggles below it, sellers gain influence. Just above that level, another key technical barrier exists near $86, which corresponds with the 38.2% Fibonacci retracement of the previous rally. Fibonacci retracement levels are widely followed by technical traders because they often represent areas where price pauses or reverses during corrections. In recent sessions, silver attempted a recovery toward higher levels, but stalled before reaching the 50% retracement zone. That failure indicates that sellers remain active whenever the price begins approaching those resistance levels. Until the market breaks through them convincingly, any rally attempt remains vulnerable to renewed selling pressure. For silver to truly regain bullish momentum, a much more significant breakout would be required. The market would need to close decisively above the 68.2% Fibonacci retracement near $99.60. A sustained move above the $100 mark would likely signal that buyers have regained strong control of the trend and could potentially open the path toward new record highs. But that scenario remains distant from the current trading range. Right now, silver is essentially trapped between the 78 support zone and the 86 resistance area. The broader bullish breakout threshold sits near $100, while the bearish breakdown threshold remains around 64. In other words, the market is currently moving inside a relatively tight corridor while waiting for a catalyst that will determine the next major direction. Price fluctuations within this range may appear dramatic on short time frames, but in the context of the larger structure, they represent the market searching for equilibrium. Technical indicators on the daily chart show that downward momentum has slowed somewhat after the initial drop. Oscillators that measure market momentum have begun stabilizing near their midpoint levels, which often occurs when selling pressure begins losing intensity. At the same time, silver still trades above several longer-term moving averages, suggesting that the broader trend has not been completely broken. However, those moving averages are gradually converging closer together. When multiple averages compress in this way, it often precedes a decisive move because the market eventually chooses a direction after a period of consolidation. Traders sometimes describe this as a coiled spring effect, where volatility decreases temporarily before expanding again once the next trend emerges. While this technical structure offers some encouragement for bullish investors, it is important to examine the counterarguments as well. A balanced analysis must consider both sides of the debate rather than focusing only on the scenario we personally prefer. The bearish case for silver is not trivial. If central banks begin reversing course and raising interest rates again in response to rising energy-driven inflation, the US dollar could strengthen significantly. A powerful dollar rally would create persistent downward pressure on precious metals prices. The currency markets are extremely sensitive to interest rate expectations. If traders begin believing that multiple central banks will shift toward tighter policies simultaneously, the dollar index could climb toward new multi-year highs. That environment would likely create additional headwinds for silver and gold. Another potential bearish scenario involves the duration of the current conflict. If military operations conclude quickly and geopolitical tensions ease sooner than expected, energy prices could retreat from their recent surge. Lower oil prices would reduce inflation fears and remove some of the pressure pushing interest rate expectations higher. In that situation, the dollar might still remain relatively strong while the geopolitical risk premium in precious metals fades. Silver could recover part of its recent losses but might struggle to produce the explosive rally that many metal investors hope for. There's also the issue of silver's industrial demand component. Unlike gold, which is primarily used for investment in jewelry, a large portion of silver consumption comes from industrial applications. Estimates suggest that between 50 and 60% of silver demand originates from sectors such as electronics manufacturing, solar panels, electric vehicles, artificial intelligence hardware, and defense technology. During an energy crisis, those industries can face rising production costs. Higher electricity prices, transportation costs, and raw material expenses may cause companies to delay projects or scale back expansion plans. If industrial activity slows due to elevated energy prices, demand for silver in those sectors could temporarily weaken. Sophisticated trading algorithms incorporate these possibilities into their models. When they detect potential demand destruction combined with stronger currencies and rising interest rates, they often respond by selling silver futures contracts. That type of algorithmic selling can accelerate price declines during periods of uncertainty. Technical traders also note that silver failed to hold the 150-day exponential moving average on the hourly chart earlier in the week. That level had previously acted as a near-term support indicator. Once it broke, price moved lower exactly as the technical signals suggested. All of these concerns deserve serious consideration. Anyone claiming that silver can only move upward from here is ignoring legitimate risks. Markets rarely move in straight lines, and uncertainty always creates the possibility of unexpected outcomes. However, there are also several factors that the bearish narrative may be underestimating. The disruption to Dubai's logistics network is a genuine physical constraint that futures markets may not fully reflect yet. When one of the primary transit hubs for global precious metals shipments becomes unavailable, it creates a bottleneck that cannot be solved instantly. Demand from Asian buyers does not disappear simply because flights are grounded. Instead, that demand accumulates while waiting for supply routes to reopen. Once transportation resumes, the backlog of purchasing activity can quickly enter the market. The divergence between paper prices and physical premiums is already providing early evidence of this tension. Premiums rising in regions such as Saudi Arabia, India, and China indicate that buyers seeking real metal are willing to pay more than the official spot price suggests. Historically, these divergences rarely last forever. Either the premiums collapse back toward the paper price, or the paper price eventually rises to align with physical demand. In many previous situations involving supply disruptions, the latter outcome eventually occurred once the market recognized the true extent of the shortage.